Welcome, everyone. Welcome to today's session. All SA startups need to know about structuring. My name is Dana Pretorius. I'm one of the co-founders and directors of Caoilfhionn. At Caoilfhionn, we love to help our clients scale, and necessary to do that, we really need to work closely with our network partners. And obviously, one of our amazing network partners that we work closely with is Caoilfhionn van der Walt. Caoilfhionn, if I can just ask you to possibly put on your screen while I introduce you to all the amazing delegates. If I can just quickly say, so Caoilfhionn is one of the partners of Regan van Rooyen. They specialize in international tax, and they specializes in structuring for businesses like yourself. So yeah, Caoilfhionn, it's so great to have you today here. Thank you for making the time. We're so excited to hear you speak all those golden nuggets. Amazing to have you.
Thanks, Dan, and it's great to be here as a founder myself. So I'm the founder of Regan van Rooyen. I'm always particularly keen to speak to other founders and entrepreneurs. And I'm really hoping today that we can have a hopefully fairly interactive session on kind of demystifying all of the whole world around structure. So can I go ahead and share my screen and start with my slides?
Very happy, Caoilfhionn. The floor is yours. Over to you. Really excited.
I hope I am sharing. Okay, yes. Great. So as Dana said, I'm a partner with Regan van Rooyen, and we're basically a structuring firm. So we're an international tax and structuring firm. And we've been on the go for 5 years. Sorry, I'm just trying to turn this into, so you can see it fully. Sorry, I think I'll have to do it like this for now. But yeah, so we do everything to do with international tax and structure. We have offices in South Africa and Mauritius, where I'm based, and in Ireland. And we work predominantly with multinationals, either coming into Africa or coming out of Africa. And especially over the last 3 years, we've been very focused on startups in particular, because startups at the moment is a huge, exciting area in South Africa. And typically we see a lot of startups who either should be setting up structures, but they're not, or are getting the wrong advice, or they're getting advice that isn't suitable for a startup. So what we want to talk to today is everything you as a startup need to know about your structure. And this is what, Michael, I might need some IT help here because I don't know how, I can't change.
Scroll up. So you see there's a screen on the top there with the...
Oh, yes, there it's, yeah. How do I get so I can see the whole screen, or is this okay?
So go up.
Yeah.
All the way to the top, and now go to the left. So you see there's a little play button with the screen up.
Oh, yes.
There.
Oh, yes. Thank you. And then enter should work. Great. Sorry, guys. You can see I'm a startup, but not an IT startup. So this is what we're going to cover today. And I would really welcome questions as we go. So if you have questions or comments on what we're covering, please write it in the chat section. And if we can, we'll address it as we go. Otherwise, we can talk it at the end. But what we're covering today can be fairly heavy going. So if we can make it interactive with questions as we go, it will be hopefully more useful. So this is what we're going to cover today. First of all, should startups even think about structure in the first place? What does a structure mean? So there's so much talk about how should we structure, what's a good structure, but what actually are we talking about when we say a structure? And what makes a good structure, more importantly? And then for us as a typical startup, how should we structure our business? What can go wrong? That's the kind of scary part of the session. When should I structure? What is the time that I as a startup should plan to implement a structure? How much does it cost to structure? And what are the next steps? So that's what we're going to try and cover today. First question, should startups really be thinking about structure? Now, I would say not always. And a lot of clients who come to us, we tell them, guys, there's no point in you structuring at the moment, because as you'll see, structuring is a complex and expensive business. And unless your business is ready for an international structure, there's no point. So, and when we talk about structure here, we're really talking about internationalizing your structure. So setting up an international structure. Should South African startups think about setting up an international structure? It's worth looking at, firstly, if you have a lot of non-South African clients. And this is what has really excited us in the last year. There's so many startups, especially in Cape Town, who are working in the sort of tech and related area, who have huge amounts of non-South African revenue. Now, those guys are perfectly suited to set up an international structure to get some of those offshore revenues in a tax efficient model. If they have some or potentially some non-South African based staff, that could mean it's a good time to structure. So when we look at a startup, we always say, are any of the founders planning to move somewhere? Because if there's 3 founders and one of them for personal reasons is planning to move to Dubai or the UK or the US, that's a very important factor in structuring. And the next element is IP. If you have or are planning to build big IP, it is definitely worth looking at internationalizing your structure. And lastly, if you are planning to be acquired, and typically the guys we see who are planning to be acquired are planning to be acquired by non-South Africans. So a lot of startups who come to us, their plan is to be bought by Google in 2 years' time for $1 billion. Now that obviously won't happen to most of them, but those who will be acquired for a high price, it's definitely worth looking at an international structure sooner rather than later. But the thing to remember with structure is it's always a cost-benefit analysis. So what is the benefit, i.e. what are the profits that we can justify as not relating to South Africa and as relating to a lower tax jurisdiction? And what is the cost of setting up a structure that will protect those profits from South African tax? So that's the answer. Basically, if you're a startup, if you're purely in South Africa, so let's say your startup is in the cleaning business and all of your staff are South African and all of your clients are South African, there's no point in looking at an international structure. But if you have staff in South Africa, maybe one of your founders is planning to emigrate to New Zealand in 2 years, and you've got 50% of your clients non-South African and you're intending to grow that in future, and you have IP that you believe will become very valuable and you're expecting to be acquired in a couple of years, then it is definitely worth looking at setting up an international structure, and probably sooner rather than later. So to continue on this, so what type of startup would best internationalize their structure? When we look at businesses, we look at the current and expected future location of 3 main tranches. So first of all, we look at where are the shareholders and the main workers. And in a startup, that's typically the founders. So where are the founders currently now, and where are they planning to be in future? That's always an important factor in determining whether it's worthwhile internationalizing our structure. Second one is, where are our suppliers and where are our raw materials? And the raw materials can include resources. And a lot of the startups we see in South Africa at the moment, they rely on the very highly skilled and relatively low cost workers that are in South Africa. So that's a very important element. If all of your workers are always going to be in South Africa, there is a limit to how much we can legitimately internationalize outside of South Africa. And the third and most important one is, where are your customers? And as a general rule, if most of your customers now and you expect in future are in South Africa, it's going to be quite limited, the benefit of you setting up an international structure versus the costs and potential risks of that. So of the 3, you look at where are the key guys, and that's for a startup, that's typically where are the founders, where are they today, and where are they planning to be in 5 years' time? Where are our workers and our suppliers of raw materials? And most importantly, where are our customers? And the more of those that are outside South Africa, the more likely it is we can set up a decent international structure. So what do we mean by business structure? Now, I assume everyone knows this, but just to be clear, We're talking primarily about the legal structure. So that means what corporate entities you have, where are they, and how are they held? So that's what your structure is. What entities you have, what jurisdiction they're in, and how they're held. But when we look at structuring, we also look at the transactional structure. So that means what transactions flow between the entities. And that is very important from a transfer pricing perspective, which we'll go into later. So if you look at, oh, here's what my perfect structure is in terms of 6 legal entities in 5 different countries and 4 different trusts, that only tells you half of the story. You have to also understand what transactions are going to happen between those entities and how are the transactions going to flow to the clients and other stakeholders. And we also need to look at the roadmap, which is basically, how do we get from where we are today to that picture? If we just draw up a lovely picture of, let's say, a trust in the BVI and a holdco in Mauritius and all of the entities underneath, and even show the transactional structures, if we don't consider how we can get from where we currently are, which might be a CC and a PTY in South Africa servicing all our global clients, if we don't look at the transactions to get from there to the desired end structure, we're also missing half of the plot, because typically that is where there is a lot of tax costs to change your structure. So that's kind of, should startups look at structure? And the answer is basically probably yes, if you're doing a fair amount of stuff outside of South Africa. Then we've looked at what is structure, and now we're looking at why is structure important. So the first thing is a structure limits shareholder liability. So a company, by definition, is set up to protect the shareholder. The company is a legal person separate from the persons who own the company, so it protects the shareholders from a liability accruing to the entity. And likewise, you can structure your entities and your holdings to limit shareholder liability in various ways. A good structure can also protect your operating assets and, importantly, your intellectual property. So it will ensure that your intellectual property sits in a country where you want it to sit and in the right group entity for you. And we will also be able to mitigate specific business risks or country risks by structuring in the right way. So if we're very concerned about, for instance, country risk in Zimbabwe, we could amend our structure so that most of our assets, for instance, are not held by the Zimbabwean entity, but they could be held by, let's say, a Mauritian entity and leased to the Zimbabwean entity, which reduces the in-country risk and protects the operating assets. We also want a structure that supports the long-term growth plans for the business, supports the strategic drivers, and supports the operating model. So what that means is you want a structure that is aligned to what you want to achieve long-term from the business. So if you're planning to go into America in future, there's no point in setting up an entity, let's say, in Iran or a country that could have sanctions with America. If we want to be, if we're building a company to sell, then we have to think about, well, what type of structure would be attractive for a buyer to buy into? We look at the strategy, for instance, what type of countries are we planning to have clients in, and our structure can suit that. So we'll choose, for instance, an operating entity that's aligned to those. And it can also align with our operating model. So what functions sit where can be aligned with how we set up our legal entities. It's also a way of facilitating how you raise funds or obtain investors. I think we've spoken about that. So if you want to borrow from a US bank, they're unlikely to want to lend to a South African entity. Or if you want to be purchased by a US private equity player, they're likely to want you to have an offshore holding company. You can use your structure to improve your currency position. So as we know in South Africa, typically you're obliged to operate in Rand with limited exceptions. And if you have an offshore entity that, for instance, takes all of your non-South African revenues, you can maintain more of your transactions in hard currency and improve your overall group currency position. Likewise, you can mitigate your exchange control restrictions by ensuring that your money rolls up in jurisdictions outside of exchange control, and we can optimize our overall tax. Now, I want to be clear that structure is not primarily about tax planning. And the days where you could just set up an entity in the BVI with a brass plate on a wall and never go there, and nothing happens there, but you push half your profits there, those days are very long gone. So there are ways to streamline our tax and optimize our overall tax, but structuring can no longer be used to basically avoid tax altogether. And because, as we'll see, there are strict regulation, there are strict anti-avoidance provisions around where you structure just to obtain tax benefits, it's very important that the commercial rationale drives any structuring decision before the tax rationale. So now we look at tax. How can my structure optimize tax? Now, it's very important to get that your tax bill is not just your corporate tax bill. And this is especially true for a startup, because for a startup, typically the founders are usually employees, directors, and shareholders. So when we look at the overall tax cost, it's not enough that we say, oh, we pay 28% corporate tax in South Africa. And you compare that. I mean, I was at the Tax Indaba last week, and a guy from SARS was saying, well, nobody will go to Mauritius because what's the benefit of 28% in South Africa versus 15% in Mauritius? And I was saying that's not a good comparison, because if you're in South Africa, and especially if you're a startup, you have to pay 20% dividend withholding tax on everything, whether you hold it via another company or a trust or directly. If you want to get if you're a South African tax resident and you want to get a dividend out of your South African company, you will pay 20% dividends tax, which means it's 28% corporate tax plus 20% tax on that. So that's an effective, I think, 43.5% corporate tax rate. Then, because the founders are typically also employees, we have to consider the employees' tax rate, which is at the highest rate is 45% over 1.5 million. Capital gains tax, also very high, 18% for individuals, 22.4% for companies. And again, that's very important for startups, because a lot of startups are intending to one day sell their business. So the growth that they're building, if they don't structure correctly, can be subject to either 18% or 22.4%. We also need to consider withholding taxes. So other withholding taxes, which are typically on royalties, services, and interest, and indirect tax. But I think the most important ones are, we cannot just, when we compare tax structures, it's not telling the full story if we look at 28% versus the rate in the other country. We have to look at the fact that South Africa has got very high dividend withholding tax and very high employees tax. Now, by comparison, so if let's say a South African tax resident receives a dividend from his South African company, he suffers 20% dividend withholding tax on that. If he receives a dividend from his offshore company, provided he holds more than 10% of the offshore company, he can suffer 0% withholding tax depending on the country from which it is paid. Let's say it's paid from the UK or Mauritius, for example, 0% withholding tax, and then it's exempt in his hands as well, because it gets the South African participation exemption. So this dividend withholding tax of 20% is very high. I'm just checking, I see what is the low watermark for international revenue to make the structure viable? We talk about that later, but it basically depends. It's not. We'll talk about the costs of structures, but I would say it's more to do with proportion. So if you have more than 50% of your revenues outside of South Africa, I would say definitely it's worth looking at a structure. But it is a cost benefit analysis, and it depends on the level of maturity that the business is at. So that's in terms of how we optimize tax. Don't just think corporate, especially for a startup. Also remember your dividend withholding tax, and we can easily reduce that 20% to zero. Also think about your employees tax. There's not that many countries apart from Dubai who have no tax for employees, but it's certainly easier to get significantly lower than 45%. And capital gains tax. If you're building a business to sell, you do not want to have to pay 18% on that sale. Okay, so, oh, sorry. Okay, so how can my structure optimize tax? So this is just talking more about the numbers on the last slide. If we run our business from South Africa, we pay 28% tax on everything we earn in South Africa, plus 20% dividend withholding tax. And we're taxed on all our revenue. So even if I have customers in the US, and even if 100% of my customers are in the US, if I'm running my business from South Africa and servicing those customers from South Africa, then I'm fully taxed on that, even though you could argue that it's not South African revenue. And if I sell again, I'm fully taxed on the gain. And if I create IP, it's sort of permanently in South Africa. So we'll talk later about, can you really move IP? And the answer is yes, sort of. It is very difficult to move IP. So if you're planning on building big IP, it's important to think about whether we can get it outside of South Africa before it's built. There is a very real risk that if you invest in your IP in South Africa, that it remains in South Africa for tax purposes and for exchange control purposes. A good structure will typically identify specific functions which can be posited outside of South Africa. And we focus on high value, low personnel functions. So, for instance, if in that example where we had 100% of our revenues from the US, we typically have what we might have in that type of situation is a couple of sales and marketing people who get on the phone and get all of the clients. And then we have a lot of technical staff in South Africa who actually do the work. So for instance, what you could do is position the sales and marketing function in, let's say, Dubai or Mauritius, and you can justify that as being, let's say, 1 or 2 people, if that's actually what happens. And then we can justify that a large portion of the profits relate to that value add that is being conducted from Dubai, and ensure that what happens in South Africa is only a low level cost plus type function. And that's kind of in theory. There's obviously a lot more complexity to it. I see we've got another question, so it's good. It's just somebody wants to email that presentation. Okay, so then, so this is our typical structure. So this is how we want to structure. How should a startup typically structure? So essentially what we want to do is set up an offshore company in a country that has no exchange control, because we don't want to have to be asking permission every time we want to make a payment in or out. One that has access to hard currency, so where I can actually do my accounts in hard currency, and where I can get hard currency funding, so I can have a dollar bank account and I can actually borrow in dollars, for instance. One that has a low corporate tax rate, one that has no tax on dividend receipts, so I want that offshore jurisdiction to be able to receive dividends from my offshore entities and not pay tax on those dividends, which is very normal. I want low or no capital gains tax and minimal withholding tax on flows out. So we'll go into this a bit more detail later, but essentially how a startup should typically structure itself is choose an offshore jurisdiction that ticks these boxes. Now we go later into where really should it be, but in general, we want one that has got no exchange control, access to hard currency, low taxes, no withholding tax. And then what you do is you set up an entity there and you put all of your non-South African revenue streams, all of your non-South African functions with a focus on high value, low personnel functions, and you put them in that entity, ensure there is enough substance, and you house your IP there. And that can also be the holding company for your non-South African subsidiaries. Now, we generally recommend that this structure is held directly by the shareholders, because if you hold it under one of the South African companies, then you'll still have to pay the 20% dividend withholding tax. As we said, if it's held directly by the individuals, there is no dividend withholding tax, or it can be via trust. So what we suggest is that there be 2 parallel structures, one for your South African structure, and then a parallel structure for your offshore entities. And in that, we house whatever does not belong to South Africa. So we'll render to Caesar what is Caesar's, but whatever is not South Africa's, we will put in this suitable jurisdiction. And as I say, if it so happens that one of the founders was intending to move to the UK, that would make that a suitable jurisdiction. If we know that most of our clients are in the UK, that could be a suitable jurisdiction. So long as it has low tax, no exchange control, and access to hard currency. And so that can be held directly or via a trust. Now, the tax implications are around a trust are quite complicated, but generally we would recommend that you do interpose a trust, simply because a trust protects against the state duty and exit charge on emigration. So and it's important to note that the offshore company needs to have substance. All of these structures will only work if there is sufficient substance in the overseas entity. So this is essentially what we are looking at. Two parallel structures. So let's say we've got two founders in South Africa. They own their South African company and the South African subsidiaries are there. Then in a parallel structure, so that blue line represents the ocean, we have the two founders and they can hold directly into offshore co or via their own trust, and then the subsidiaries are held underneath the offshore co. That's a kind of very simple type of structure. And then some of the flows here, there could be flows from the offshore companies to SA co or from the SA subs to some of the offshore co's, and dividends will obviously flow up the chain. So then we talk about IP. Can I move IP from South Africa? The answer is, like in general terms, it's probably no. It is possible, but it is very difficult to move IP. And that is because not only does the taxman hate to think of South African IP being moved, but the Reserve Bank also is allergic to the idea of IP that's created in South Africa being exported. So if you want to sell your IP to a connected person overseas, which means any group entity, anyone in your family, or any trust to which you're either a beneficiary or a settlor, then South African Reserve Bank approval is required for that, which is quite a time-consuming process. And more often than not, they say no. So that is, you can't rely that you will be able to do that. If you're if you're selling it to a non-connected person, you don't need the Reserve Bank approval. You just need to notify Reserve Bank, but you do need to be careful with the valuation of IP. And it is notoriously difficult to value IP. And you can assume that if you're selling it to a connected person, that SARS will be trying to argue for as high a value as possible. And so it's something to treat very carefully. Also, to determine whether IP exists at all and where it exists, especially in a startup situation, can be very complex. Now, this can be to our advantage because often we find that IP doesn't actually exist. And then even though the business might think it exists, and we can then support the business to bring it into existence in a suitable offshore location. Not always, but it is possible sometimes. It's important to note that IP for tax purposes is not the same as intellectual property for accounting, which is not the same as IP for legal, which is not the same as IP for SAR. So when we're thinking about IP from either the tax perspective or the accounting perspective or the legal side or Reserve Bank, we might be talking about slightly different objects, which adds to the complexity. We also have to remember that there has been a lot of suspicion from tax authorities on IP structures over the last few years, and they have been scrutinized very closely. So if you have IP within your group, and particularly royalties or license fees relating to the IP flowing around your group, the transfer pricing around that will be very complex and will very likely be subject to quite a high level of scrutiny by SARS. The DEMPI concept has been pushed by the OECD to focus on to try and stop groups from just parking IP somewhere and allowing significant royalties to accrue to that. And it says the IP doesn't just reside where the piece of legislation or the contract or the formal physical IP sits. We have to look at where the IP is actually developed, enhanced, maintained, protected, and exploited. and you look at where each of those functions take place and use that to allocate the taxing rights related to IP. So IP, very, very complex area in any high tax country, but in South Africa, where we also have exchange control, which is paranoid about South Africans moving IP, it's even more difficult. Looks like we have another comment. So now that loop ownership structures are allowed, is it wise to hold a South African company by an offshore holding company? I would say yes. So yes, if you can get away from a significant, it's certainly worth considering. And this is something we do cover later. So it used to be forbidden for a South African person to hold a South African asset via offshore. Since March this year, that has been permitted, and we see this as allowing huge flexibility, especially for startups. So I would say yes, it should always be considered. It is not always necessary, and there are some strict anti-avoidance rules around just putting a loop structure in place, but it should definitely be considered, and it can unlock benefits. So another attendee said, do you not pay tax when you pay for the IP used in South Africa to the tax-free country? I'm not quite sure I understand that. What transfer pricing will require that if the IP is in South Africa, if someone else uses it in a different country, South Africa has to earn an arm's length royalty fee for the use of that IP. So that's what I'm saying, the transfer pricing around it is very complex. If you sell IP to an offshore company which is not a connected person, you also need Reserve Bank approval. So this area is quite contentious, but our position is you do not, you just need Reserve Bank notification. But I know that there are views that you do need Reserve Bank approval even to sell IP to an offshore, to an unconnected person. Okay, I think that's all our comments for now, but please do come in. It's great to see that some people at least are listening. Okay, so that's the answer. Can I move IP from South Africa? Sort of. And I would say if you really think your business is IP heavy, get structuring advice before you start really physically creating the IP or you know, having large IP. The other thing I would say, and this is something we often do with our clients, IP is very contentious and regarded with great suspicion by any high tax jurisdiction. So often we look at, do we really want to call this an IP, or do we really want to think of this as an IP entity? Sometimes it can be much easier to think of it as a services entity and kind of ignore the IP. Now that's not always possible, but just to note that startups are always or usually very keen to harp on about the value of their IP and charge license fees and royalty fees, but there can often be a better way of looking at it, which is still correct, but can make it much lower scrutiny from a tax perspective and make it easier from a transfer pricing perspective. So rather than focus on the IP, you focus on the specific services that are being offered. So we've got some more comments. In terms of raising capital, how do you put a valuation on the IP you've created? Yes, that is how long is a piece of string. And you know that SARS will want to value it as high as possible. And when we're going to pay capital gains tax on it or approach the Reserve Bank for approval to transfer it, we obviously want the value to be as low as possible. So it is an extremely complex question. And like all complex questions in tax, the only answer is it depends. And there is a range for valuations, and we need to look at which is the most appropriate for the person we want to value it to. But a lot of people have been caught out, and often startups, by arguing for very low value, but then there are documents in place that make it clear that there is a third-party person agreeing to buy it in a year's time at a much higher value, so that there is market value support for a higher value. So it's something you have to be very, very careful with. And that's part of why I say, if you can, don't get the IP in South Africa in the first place, because the valuation around moving it is a massive process. And also think about, do we really want to have this from a tax perspective as an IP heavy business? So that's linked to just the complexity there. Can you expand on the substance required in the offshore holding company? Yes, we're talking, I talk about that later when we talk about what can go wrong. And again, the level of substance, the answer is it depends. So it depends what you're putting there. But if you think in simple terms, if you've got 100 people in South Africa and you've got one person in the BVI, it's going to be very hard to justify a high overall margin accruing to the company in the BVI. So the amount of substance depends on the functions that we're positioning there and the values that we're relating to them. And that's why, as I say, the structure is not just about the legal entities, it's how you structure the transactions between them, because that is linked to this very substance question, which is at the basis of the transfer pricing risks and the basis of all of the South African anti-avoidance risks that we have to consider. Okay, so the next one is what can go wrong a lot. And this is something that I really want to emphasize, especially to startups, because especially since I've moved to Mauritius 3 years ago, I've come across so many smaller companies who have, sorry about that. I had strict rules not to get interruptions, but not always listened to. Yes, so it is, we have often seen small businesses get kind of shoddy advice and set up in Mauritius or another jurisdiction and just not do it properly. And then it has led to huge problems. So I do not want to underestimate the complexity in setting up overseas, especially for a startup, and especially if it's your first overseas jurisdiction. There is a lot that can go wrong when you set up overseas, and we deal with them quickly on this page. And this is kind of the acronyms from hell. If you get into the international tax space, these are the main acronyms that we need to be aware of and the main risks that can affect us. So the first one, and we talk about these in later slides, and these are kind of in order of how bad they are. The first one is the place of effective management. So if we set up a company in the BVI, but SARS is able to argue that we're actually managing it from South Africa, then it will be resident in South Africa and we don't get any tax benefits. The second one is a permanent establishment. So again, if we set up a company in the BVI, but there's no staff there, and actually the staff are working in South Africa, then that would create what's called a permanent establishment or a taxable presence in South Africa, which then is subject to tax in South Africa, and again, negates a lot of the benefit. So we wouldn't have the whole company's profits taxed in South Africa like on the first option, but we would have a good chunk of them. The next one then is controlled foreign company legislation. So if more than 50% of the shares or voting rights or participation rights in the offshore company are owned by South African residents, then that company is what's called a controlled foreign company, which means that South Africa can tax the South African shareholders on the CFC's profits unless it meets a specific exemption. The next one is transfer pricing, and transfer pricing is really the risk that underlies everything. I was talking at a conference last week and I was saying, actually, if transfer, in theory, with transfer pricing legislation, you don't need any other legislation, because what transfer pricing says is that we look at what happens between the two entities. So we've got the company in South Africa, we look at what they earn. We have got the company in the BVI, we look at what they earn, and we ensure that the split of profits between the two and how they charge each other and how they transact with each other is fair. It has to be at arm's length. So that's the next acronym. The other two are more to do with the motive. So the first one is what we call the GAR. So, and again, most countries have these provisions or variants of them. It's not just South Africa, but South Africa is very aggressive in applying them at the moment. So the GAR is basically whatever you're doing, even if it's perfectly legal, if SARS are of the view that you are doing it primarily to avoid or reduce South African tax, then they will just totally ignore what you've done. And it's important to note that the burden of proof is on the taxpayer. So SARS doesn't have to prove that you are doing it for tax purposes. You have to be able to prove that you're not doing it for tax purposes. So this is one that a lot of people forget, and it is one that can bite you quite hard. The next is reportable arrangements. So there's a list of specific types of transaction that SARS sees as naughty. And if you do any of those, you have to actually go open kimono to SARS and disclose everything about them. So typically when we're looking at a structure, we always look at, could it be a reportable arrangement? And if it could be, we just won't do it because we don't want to have to report everything to SARS. So we've got another question. Our biggest problem with setting up overseas are the costs. Use all the money to build the business and all the structures cost a lot of money. I agree. And this has been very close to my heart, especially since I moved to Mauritius, because it is expensive to set up in these jurisdictions. So what we call the finance centers, which is the kind of PC word for tax havens, because you're not allowed to say tax haven anymore. But places like Mauritius and the Seychelles and Dubai, Hong Kong, Singapore, those countries, they've got low taxes, but it's expensive to set up. So in South Africa, I can set up a PTY for like 400 Rand in 10 minutes on the CIPSI website. In Mauritius, I have to use a management company. I have to pay a 5,000 odd fee. I have to get local directors. So basically costs minimum $12,000 to set up a global business license company in Mauritius. And Mauritius is definitely the cheapest of all of the kind of reputable offshore centers. So that is definitely true. It is not cheap to just set up a company, and also it is not cheap to run it properly. As I said, the days of just setting up a company and pushing all your profits there and not paying any tax, those days are long gone. So to actually ensure you have the appropriate level of substance in the offshore country is not cheap, and it also impacts significantly on the business, especially if you're a startup and you've got a small team of people who work closely together. If you need to move two of them to, let's say, Dubai to unlock some massive tax benefit, you have to think about the cost of that, not only in terms of the setup costs, and Dubai is significantly more expensive than Mauritius, the travel costs, the extra living costs for the individuals who are going there, but the impact that will have on the business in having this dislocation of the core team. And especially for startups, this is a very real impact. And as we'll see later, the costs of setting up a structure are nothing compared to the cost if it goes wrong. And it very, very often goes wrong if people do not apply their minds to it correctly. So the next few slides, we're going to go through some of these risks. I see we've just got some more questions. Some example. Yeah, okay, so examples of reportable arrangements. There's a lot of very specific ones, and I didn't go into it because I didn't think they'd be relevant for startups. They're typically quite convoluted. It's things to do with equity share backs, things to do with buying a company that has a loss and then using the loss. And there are ones to do with setting up a trust where there's going to be a benefit of 10 million Rand. There's ones to do with having an offshore entity that then provides training or other consulting services back to South Africa, which people can often inadvertently fall into, but I don't think people on this call. And there are also ones to do, and this is worth bearing in mind if you've got people trying to kind of sell you clever structures. If you enter into a transaction where there's a tax accommodating party, which is typically the person who's trying to sell you a structure, where you pay them a fee that's based on a tax saving, or where the structure is based on obtaining a tax saving through introducing that third party, that is a reportable arrangement. Again, I don't think any of these will apply to the audience today, but it is very important to make sure that if you're doing anything slightly funny, you make sure it's not a reportable arrangement. So we've got one more comment. How would SARS even know about the structure, and why would I need to answer to SARS? Okay, so this I think is important to say to startups. It is no longer possible to use as a defense, how will SARS ever know? SARS's powers are broader now than they have ever been, and they are more aggressive now than they have ever been. And where SARS is targeting is the small number of high net worth individuals who are moving things overseas, or setting up businesses and moving them overseas. So it is not anymore possible to take that as a strategy. SARS can find out a terrifying amount. There's common reporting standards in place. There's the mutual exchange of information agreements. SARS can get to know a scary amount of detail, and all of the kind of reputable countries that are the only possible ones to set up an international structure in nowadays, if you want to be bought or transact with other clients, have exchange of information agreements with the South African Revenue. So you have to assume that SARS can get any information they want. I see we're running out of time. I'm just going to go through these quite quickly. So the first one is in fact, I think I'll skip these. These are just the risks. We've spoken through them fairly quickly, and that's how South Africa essentially extends the sovereignty of South Africa, so that even if you set something up overseas, you can't just say, oh, well, now it's overseas, SARS can't get it. Not at all. Place effective management, permanent establishment, control of foreign company, transfer pricing, all of those things can mean that you're still taxed in South Africa. So when should we set up an international structure? And this is something we're often asked. And the theoretical answer is as soon as possible. But the practical answer is wait a little bit, because structures are very expensive to do. They're more expensive if you don't do them right. And the time taken to, the management time taken to set them up is quite serious. So what we say is that you should really wait until you're expecting substantial, I mean, only you will understand the level of maturity that your business is at. But if you are setting up a company and you are sure that it is going to be the next Google or the next Uber, then definitely spend the money, move the people, create the substance, make sure the IP is in the right place, make sure you set up your structure in the right place. But most people, they think their business is going to be a big success. They think they're going to sell it for $1 billion to Uber or whoever, but they don't know. So what we would say, especially to small businesses, is it's better to be a little bit too late than too early. And that's just in terms of the cost benefit analysis. Structures are expensive to set up. They're time consuming to set up. The tax risks around them are a complete headache. And the risk of getting them wrong is very big. So we would say a good time is when you expect substantial non-South African revenues. And what substantial means will depend on you. I would say you should expect to spend at least $15,000 on an international structure, just setting up the companies, running the companies for a year. So, and then you have to think about the extra cost of moving people there. So you have to bear that cost in mind and compare it to the tax that you're saving, and then determine how substantial your non-South African revenues have to be. Or if you are going to develop IP and you really think it's going to be a game changer, then it's a good time to set up a structure. And if you have staff offshore. So that's why, as I say, we always ask, do you have any founders that are overseas? Because that can really help in the early days in terms of structure. I'm going to fly through these quickly. So where it depends on where you expect your founders. and your shareholders and your investors to be, but especially where your clients are. That is the most important. You also have to think about, do you need a specific legal regime? Like, are you doing something funny like gambling or cryptocurrency, where you need to be in a jurisdiction that's got a specific legal regime, or for IP protection, how important that is to you? You also have to think about language, time zone, reputation, especially many startups are building to sell. So you don't want to be setting up an offshore jurisdiction in an offshore company in a jurisdiction that is not seen as kosher. So generally, as we've said, you want to set up in an offshore jurisdiction, no exchange control, low taxes, low CGT. It should have a lot of double taxation agreements, especially if you're doing business in Africa, because withholding taxes in Africa are very high, and double taxation agreements can significantly reduce those. And so I know that's been kind of quite a lot of waffle about where. So typical jurisdictions for South African businesses, and this is just quite high level. Mauritius is very good for Africa. A lot of startups are not focused on Africa, so Mauritius doesn't work, or doesn't work as well. But Mauritius can often be a very good kind of starter structure. So like they have starter marriages, Mauritius can be a good starter structure for South African business, because it's cheap, it's close to South Africa. It can get us out of the CGT net and give us a low tax regime. And then later, you can change the structure into something that's more suitable for, let's say, the US, if that's your target market. The UAE is another one, much more expensive than Mauritius, and under pressure because it's a zero tax rate. So it's, I mean, the OECD and all the BEPS initiatives obviously hate those 0% tax regimes. Cyprus and Malta I've put together because they're both in the EU, both low tax rates, both under a bit of pressure in terms of their low tax regimes, but they can be attractive. Especially Cyprus at the moment has got some nice IP incentives. Delaware LLC, US, I generally try not. The US is a whole other level of complexity when it comes to tax. Delaware LLC is a very tried and trusted approach, but the issue is what holds the Delaware LLC. Then there's the Channel Islands, so the Isle of Man, Guernsey, Jersey, all pretty expensive, especially for South Africans. So they'd be kind of twice the cost of Mauritius, and don't have great treaties with Africa. Then there are the kind of non-tax havens or non-finance centers, which are still very favorable from a tax perspective. And I think these are often worth considering. So that's Ireland, the UK, and the Netherlands. All of those have very good tax regimes. The UK used to be great, no withholding tax, which is a big one. So if you hold via trust, you don't suffer any dividend withholding tax, whereas Ireland can have a 25% withholding tax. But the UK tax rate is now going up. It was at 19%, expected to drop to 17%. Now it's going up to 25%, which is a big jump. And obviously with Brexit, there's some issues there. Hong Kong, Singapore can be suitable, also very expensive. And then right at the bottom of the list, I put Seychelles, the BVI, Cayman, Panama. I don't recommend that people look at those types of jurisdictions. They all have a limited shelf life. For instance, the Seychelles, it's now impossible to set up a Seychelles bank account. None of the banks will transact there. And they're all under immense pressure and from the various global oversight bodies. And typically, investors or funders will not be interested in entities that are based in those jurisdictions. How much? As I say, I think you should aim for at least $15,000 a year. That's if you're looking at an onshore a finance center jurisdiction like Mauritius, Dubai, Hong Kong, Singapore. Mauritius is by far the cheapest. The non-tax havens, to use that word, are much cheaper. So UK, the Ireland, Netherlands, you can set up your own company for a couple of £100. But you also must remember your travel costs, your board meetings. Don't forget the management time and effort to now have some of your key people overseas. And again, the real cost is when it goes wrong. So fools rush in when it comes to structure. You really have to think it through and remember that your structure is not just what entities go where, it's how they transact with each other, and it's how you get from where you are now to there. Okay, so what's next? We say you should basically So unless you're completely in South Africa and will always remain in South Africa, there's no point in looking at an international structure. Otherwise, if you have some South African elements, it's worth looking at, okay, what do we think we should aim for? So what's our kind of roadmap for a structure? And then understand how to work towards that. So we'll decide, okay, we're not ready to do it now, but when our revenues get to X amount, or when we're ready to launch that new round of funding, or when we're going to develop this new piece of IP, that would be the time to hit the button. But then we need to understand how to safeguard that plan. So we have to know what to do and what not to do to ensure that that roadmap is protected and supported, and we're continuing to support that narrative rather than derail it. And then we identify the specific triggers to start structuring. So it can be in terms of revenues or funding or IP, and get good advice. I always say, do not start with the person who's going to set up your company. You want to start with a tax advisor, and not in the low tax jurisdiction. You want to start with a tax advisor in the high tax jurisdiction, because the South African tax risks are what are key here, not the Hong Kong or Mauritian or BVI tax risks. And then lastly, we do have a special offer for our friends at Outsource CFO. So for Outsource CFO clients, we have a very discounted fast track structuring workshop of 22,500 rand. And basically we send a smart questionnaire, which you fill out online beforehand. And then we have a workshop where we, based on the information from the questionnaire, develop your roadmap. So what you should do, what you need to worry about now, what your triggers are, when you need to push the button. Limited spaces for this special offer. So if you want to do that, my contact details are here. Now, I think we have a very few more minutes for questions. Yes, so John, I think we will share the slides. Yes. And then, so someone says, if I'm less concerned about tax, which is always good to hear, because the structure will only work if it's driven by the commercials primarily. I'm more concerned about the ability to raise capital and sell my business. Does that reduce complexity? Well, yes, but it's obviously good to do both. So I'm not in favor of, aggressive tax planning, but I do firmly believe that every business person is fully entitled and indeed should structure their affairs in a way that's tax efficient. So it is definitely, there is a lot of scope for any startup in South Africa that's focused on non-South African clients or that's IP heavy. There is a lot of scope to optimize their structure to, amongst other things, reduce their taxes, and also to be able to have a presence in an entity, in a jurisdiction in which it's easier to raise capital and get investors. So I would say, yes, it does reduce complexity, but I mean, SARS is always going to be suspicious of anything that a South African business moves offshore. Do we have any other questions? I see we're just coming up to the hour. Otherwise, my email address is on the last slide. I would recommend, if anyone is interested, to look at our website on our tax news. We publish a newsletter every week, which I think are generally quite relevant. If any of you have any questions, please drop me an email. Always happy to chat. And otherwise, I think we are done for today. So thank you very much for your attention, and I hope to hear. I have another question here before we go. So in worst case, if you get it wrong, you're taxed at maximum local tax rates. No. Worst case is really a worst case. Worst case, you can end up paying the tax you've underpaid plus 200% penalties plus interest. So that's why I say with structure, the real cost is if you get things wrong. Getting things wrong in international tax is a hideously expensive exercise. Okay, everybody, I'm going to close here. Thank you all very much for your attention, and feel free to email me with any further questions.
Hey, Lo here. I'm one of the founders of Outsource CFO. If you like this video, don't forget to click subscribe below. We'll see you next time.